was over, they'd lost 80% to 90%. Buying the first dip is one of the most expensive mistakes in investing, because the first dip is never the last dip in a leverage unwind. December 2025 through January 2026 will look like this. After the initial crash in November or December 2025, there will be a stabilization, maybe even a rally. The Dow might recover 10% to 15% from the lows. Financial media will say the bottom is in, that it was just a correction, that the fundamentals are strong. They'll interview CEOs who express confidence. Analysts will put out buy recommendations. Retail investors will be told this is the opportunity of a lifetime. And some will believe it. They'll buy. And they'll be wrong. Because what's happening underneath is banks are tightening, credit is contracting, businesses are cutting, layoffs are beginning, the recession is starting, and recessions feed back into markets. When earnings start missing, when unemployment spikes, when the economic data turns clearly negative, the market will roll over again. This stabilization phase, this false hope, it's a trap. It's month 2 and 3 of 18. And the people who buy here thinking they're getting a bargain will watch their positions cut in half over the next year. The signal to watch for is the failed rally. When the market bounces 10% to 15%, but then stalls, can't make new highs, starts drifting lower, that's when you know the dead cat bounce is over. That's when the next leg down begins. This is where most of the wealth gets destroyed, not in dramatic crashes, in a slow, grinding decline that exhausts everyone psychologically. January 1930, the market is down about 35% from the peak. But it doesn't feel like a crisis anymore. It feels like a bad year. People are hoping for recovery, believing that 1930 will be better. It's not. Month by month, the market grinds lower. February down another 5%. March down 3%. April, a small bounce, up 2%. Then May, down 7%. June, down 10%. It's relentless, and the psychological toll is brutal. Every time you think it's stabilized, it drops again. Every rally fizzles. Every piece of good news is overwhelmed by bad news. And the economic data is getting worse. Unemployment, which was 3% in 1929, hits 8% by mid-1930. Factory production is down 20%. Commodity prices are collapsing. Farmers can't sell crops for enough to cover their costs. Wages are being cut. Companies that are still operating are reducing pay to avoid layoffs. And banks are starting to fail. Not the big money center banks yet, but regional banks, rural banks, small town banks. In the first 6 months of 1930, over 600 banks closed their doors. And when a bank fails, depositors lose everything. No FDIC, no insurance. Your money was there, now it's gone. This creates panic in communities. People who still have money in banks start withdrawing it. Better to have cash at home than risk losing it in a bank failure. But when everyone withdraws at once, even healthy banks fail. They don't have enough cash on hand. Most of it is lent out. By June 1930, the Dow is at 220, down 42% from the peak. And people are starting to realize this isn't a correction, this is something worse. But they still don't know how much worse. The really devastating part of this phase is the hope that keeps getting crushed. If the market just crashed in one day and stayed down, people could accept it, move on. But the slow grind, the constant false hope followed by more declines, it destroys people mentally. They hold positions that are down 30%, 40%, 50%, waiting for recovery. And it never comes. They watch their neighbors lose jobs. They see businesses in their town close. They hear about more bank failures. And still they hold, believing it has to get better. This is months 4 through 9, January through June 2026. Based on the pattern, this is what the first half of 2026 looks like. The market grinding lower, not crashing, grinding. Every month a new low, every rally failing. The economic news getting progressively worse. Unemployment climbing from 4% to 7% to 10%. Corporate earnings missing expectations quarter after quarter. Major companies announcing layoffs, thousands, tens of thousands at a time. Banks starting to report losses. Write-downs on commercial real estate loans, on corporate debt. Some regional banks failing. You'll start hearing names, banks you've never heard of in cities you don't know. But each failure makes people more nervous about their own bank. And the Federal Reserve will be trying to fix it. They'll cut rates. They'll restart QE. They'll do everything they did in 2008 and 2020. They'll print trillions, and it won't work. Because the problem isn't lack of liquidity. The problem is too much debt. When everyone's balance sheet is destroyed, when nobody wants to borrow because they're already over-leveraged, monetary policy is useless. You can't push on a string. By June 2026, the market will probably be down 50% to 60% from the peak. The Dow and S&P cut in half, trillions in market value gone. And most retail investors will still be holding, still hoping, still believing it will recover. They'll have watched their 401ks get cut in half, watched their net worth evaporate, watched years of savings vanish, and they'll be exhausted, psychologically broken, emotionally drained. And that's when the next